Picture this. You're sitting in your doctor's office waiting room, flipping through a magazine you're not really reading, when you overhear two women behind you talking. One of them says she just turned 52 and discovered that her retirement account has been bleeding money for years without her even realizing it. Not because the market crashed, not because she made bad investments, but because of something she never even knew to look for. The other woman laughs nervously and says she hopes that doesn't happen to her, but there's this edge in her voice that tells you she's not entirely sure it hasn't already. You put down the magazine and start thinking about your own accounts, your own assumptions, the things you've been meaning to check but haven't gotten around to yet. And suddenly that waiting room feels a lot smaller than it did 5 minutes ago. Let me tell you something. That conversation I just described, some version of it is happening right now in waiting rooms, coffee shops, and living rooms all across this country. And the wealth killer those women were talking about isn't some exotic financial instrument or a scam from a stranger on the internet. It's something far more common, far more invisible, and far more devastating, specifically for women over 45. It's called fee erosion combined with inflation drag, and it's quite possibly the most insidious threat to your retirement security that nobody is warning you about. This isn't the kind of thing that shows up as a red alert on your phone or triggers a call from your financial advisor. It works slowly, quietly, year after year, extracting wealth from your future while everyone tells you everything is fine. My name is Felicia, and I spend way too much of my time digging into the financial blind spots that keep women stuck, scared, and silently watching their future slip away while everyone else tells them they're doing fine. If you've ever looked at your retirement account and wondered why it doesn't seem to be growing the way it should, or if you've been told your investments are on track but something in your gut keeps telling you the math isn't adding up, you're going to want to stay with me for this one. Because today we're not just talking about fees or inflation as separate concepts. We're talking about how they combine to create a wealth destruction machine that specifically targets women in midlife and beyond. And I promise you, once you see what's actually happening inside your accounts, you'll never look at that quarterly statement the same way again. Here's what they don't want you to understand about fees. And I mean really understand, not just the surface level explanation they give you when you ask questions at your annual review. Financial advisors, fund managers, and retirement plan administrators have spent decades perfecting the art of making fees invisible. Not illegal, not hidden exactly, just invisible in that way where technically the information is available if you know where to look and how to interpret what you're seeing, but practically speaking, most people never do. They bury the numbers in prospectuses that run hundreds of pages. They use terminology that sounds technical and intimidating. They structure fee disclosures in ways that require a finance degree to decode. And here's the kicker that should make you genuinely angry. Women over 45 are more likely to be in high-fee investments than any other demographic group. According to a 2023 analysis by the investment company Institute, women in this age bracket are disproportionately concentrated in actively managed funds and target date funds with expense ratios that can be 3 to 5 times higher than comparable index fund alternatives. Now you might be thinking, okay, Felicia, but we're talking about maybe 1% versus 0.2%. How much difference can that really make? And this is exactly the psychological trap they're counting on you falling into. Your brain naturally minimizes small percentages. 1% sounds like nothing. It sounds like a rounding error. It sounds like the difference between leaving a 15% tip and a 16% tip at dinner. But here's what your brain doesn't automatically calculate and what the financial industry is absolutely banking on you never figuring out. That 1% doesn't just disappear once. It disappears every single year, compounding against you in the exact same way that returns are supposed to compound for you. The mathematics of compound interest work in both directions, and the financial industry has weaponized that math against you. Let me make this painfully concrete because I need you to feel these numbers in your gut. If you have $400,000 in retirement savings at age 45, which is actually pretty good and puts you ahead of most American women, and you're paying a 1.2% expense ratio instead of 0.1%, that difference doesn't cost you $4,000 over your remaining working years. It costs you over $170,000 by the time you're 65. That's not a typo. $170,000 extracted from your future for the privilege of having someone else pick stocks that, according to S&P Dow Jones research, underperform the market 89% of the time over 15-year periods anyway. You're paying premium prices for below-average results, and the industry has convinced you this is normal. But the fee erosion story gets so much worse when we layer in what's happening to women specifically during this life stage. Let me tell you about a pattern I've seen over and over again, and I need you to be honest with yourself about whether any of this sounds familiar. Somewhere in your late 30s or early 40s, you probably made some responsible financial decisions. Maybe you increased your 401k contributions after finally getting that promotion you'd been working toward for years. Maybe you opened an IRA because you read an article about retirement readiness. Maybe you rolled over accounts from previous jobs into what someone told you was a better option. And whoever helped you make those decisions probably put you into investments that felt safe, that felt appropriate for a woman your age, that had nice names like balanced funds or managed portfolio solutions or retirement income strategies, and they probably told you not to worry about the details, that they would handle everything, that this was just how responsible people invested for retirement. Here's what they didn't tell you. Those comforting names and that hands-off approach came with a price tag. And not just the stated expense ratio, which is bad enough, there are often layers of fees buried inside these products like Russian nesting dolls of wealth extraction, sub-advisory fees, administrative fees, revenue sharing arrangements that your plan administrator negotiated with fund companies, which means a portion of your money goes to your employer's vendor rather than staying in your account. Trading costs that don't show up in the expense ratio at all. A 2022 Department of Labor study found that the average participant in a small employer retirement plan pays total fees of around 2.3% annually when you account for all the layers, 2.3% every single year, working against your compound growth while you're told to stay the course and trust the process. Now let me explain why this hits women over 45 harder than almost anyone else, because the timing couldn't possibly be worse. By your mid-40s, you've theoretically entered your peak earning years. You should be in a position to maximize contributions and take advantage of catch-up provisions once you hit 50. This is supposed to be the decade where you really accelerate your wealth building after all those years of building your career, raising kids, managing households, and generally doing everything that the economy depends on women doing without properly compensating us for it. But here's the cruel mathematics of what's actually happening. According to the National Institute on Retirement Security, women arrive at retirement with 30% less saved than men on average. We already start this crucial decade behind because of pay gaps, career interruptions for caregiving, and all the invisible labor that never shows up on a paycheck. And then fee erosion takes a bigger bite out of our accounts precisely because we have less cushion to absorb it. A man with $600,000 saved who loses 1.5% to fees annually is still left with more than a woman with $400,000 saved who loses the same percentage. The wealth gap compounds on itself, and high fees accelerate that compounding in the wrong direction. But I promised we'd talk about inflation drag too, and this is where things get truly frightening for women in midlife. Here's what most people don't internalize about inflation, even though they know it exists intellectually. Inflation doesn't hurt everyone equally. It specifically and disproportionately devastates people on fixed or declining incomes, and it punishes anyone who isn't earning returns that significantly outpace it. And guess what demographic is most likely to be shifting toward more conservative investments, precisely when they need growth the most? Women over 45. There's a toxic piece of conventional wisdom that's been circulating for decades, and it goes something like this. As you get older, you should become more conservative with your investments. Shift from stocks to bonds. Protect what you have. Don't take risk. This advice sounds reasonable on the surface, and for some people in some very specific situations, elements of it make sense. But when it's applied as a blanket recommendation to all women entering midlife, it's financial malpractice dressed up as prudent guidance. Let me explain why this supposedly safe approach is actually putting your future at risk. According to Social Security Administration data, a woman who reaches age 45 today has a life expectancy of approximately 40 more years. You're potentially investing for 4 more decades of life. That's longer than the entire career you've already built. And yet the conventional advice pushes women toward bond-heavy allocations that might return 3 to 4% annually in a good environment. Meanwhile, inflation has been running anywhere from 2 to 8% over the past few years, with the Federal Reserve's own projections suggesting we'll see elevated inflation for longer than previously expected. Do the math on that. If your conservative portfolio returns 4% and inflation runs at 3.5%, your real return is 0.5% annually. You're barely keeping pace with the rising cost of everything you'll need to buy in retirement: healthcare, housing, food, prescription medications, the things that, by the way, have been inflating faster than the overall consumer price index for years. Now combine that inflation drag with the fee erosion we already discussed, and watch how fast the wealth destruction accelerates. Your conservative investment returns 4% gross. You lose 1.2% to fees. Net return is 2.8%. Inflation runs at 3.5%. Your real return is negative 0.7%. You are getting poorer in real terms every single year while your statements show a positive balance. This is the silent wealth killer in its purest form. It doesn't show up as a red number on your account. It doesn't trigger any alarms or warning notifications. You can go years, even decades, without realizing it's happening because the nominal numbers keep going up even while your purchasing power steadily declines. And here's the part that makes me genuinely angry when I think about it. The financial advice industry knows this. They understand the math perfectly well, but they keep recommending conservative allocations to women over 45 because it protects them from liability. If the market drops and you lose 20%, you might sue or file a complaint. If inflation and fees slowly erode your wealth over 15 years until you can't afford retirement, that's somehow your problem. They did their job. They put you in safe investments. They followed the conventional wisdom. They're covered. Let me tell you about something that happened to someone I know, and I need you to understand that versions of this story are playing out right now in millions of households across this country. She's 53 years old, did everything right by conventional standards, maxed out her 401k contributions for over a decade, worked at the same company for 18 years, rolling her account into whatever plan they offered each time they switched providers. Never touched the money. Never panicked during market downturns. Never tried to time the market or chase hot stocks. Model investor behavior in every way the industry tells us to measure it. Last year, she finally sat down and actually looked at what was happening inside her accounts. Not just the total balance, which looked respectable at first glance, but the actual underlying holdings and fee structures. What she found made her physically sick. Her target date fund had an expense ratio of 0.6%, which sounds reasonable until you realize the underlying funds it held each had their own expense ratios that effectively doubled her total cost. The stable value fund she'd been told was protecting her had earned an average of 2.1% over the past 5 years, while inflation averaged 4.3%. And buried in her plan documents was a revenue-sharing arrangement that meant an additional 0.3% of her balance was being skimmed every year to pay for plan administration on top of all the other fees. When she ran the numbers on what those combined drags had cost her over the past decade, the total came to just over $87,000. That's money that should be compounding for her future right now. Money that should be buying her options and freedom and security in retirement. Gone. Not because she made mistakes, but because she trusted a system designed to extract maximum value from her while delivering minimum transparency. And the worst part? When she brought these concerns to her financial advisor, he told her she was being too aggressive in her expectations, that these were normal fees for someone in her situation, that she should be grateful her balance was as high as it was given the market conditions. Bless his heart, he really thought he was helping, but what he was actually doing was gaslighting her about the wealth that had been systematically extracted from her account for over a decade. Now, here's what I need y'all to understand about why this particular wealth killer is so dangerous right now in this specific economic moment. We're living through a period of profound economic uncertainty, unlike anything we've seen in a generation. Interest rates have been volatile after years of historic lows. Inflation proved far stickier than economists predicted and far more damaging to retirement portfolios. The bond market, which is supposed to be the safe haven for conservative investors, has experienced its worst returns in decades. That 40-year-old advice about shifting to bonds as you age, it was developed in an environment where bonds reliably returned 6 to 8%, and inflation averaged under 3%. That world doesn't exist anymore, and pretending it does is costing women their financial futures every single day. According to a 2024 report from the Employee Benefit Research Institute, women who are currently between 45 and 54 have the largest retirement savings gap relative to their projected needs of any demographic cohort, not the youngest workers who have decades to catch up and compound their way to security. Not the oldest workers who are closer to Social Security eligibility and often have pensions from a different era. Women in midlife, us, we're the ones facing the biggest shortfall, and the silent wealth killer of fee erosion plus inflation drag is making it worse every single day that passes without us taking action. The clock is ticking, and every year of inaction costs more than the year before because that's how compound interest works against you, just like it's supposed to work for you. So what do you actually do about this? How do you fight back against a wealth killer that's been specifically engineered to be invisible? Here's what they won't tell you at the bank, but what I need you to understand down to your bones. The first step is a complete fee audit, and I mean complete. Not just glancing at the expense ratio on your main funds and calling it a day. You need to dig into every layer like an archaeologist excavating a site. Check for sub-advisory fees. Check for administrative fees. Check for revenue sharing arrangements in your employer plan. Look at the trading costs and turnover ratios. If you have a financial advisor, demand a complete accounting of every dollar they receive in connection with your account, whether it's a direct fee or a commission or a payment from the fund companies for recommending their products. According to a 2023 survey by FINRA, nearly half of investors don't know how their financial advisors are compensated. Half. And the industry likes it that way because transparency is bad for their business model and great for yours. The second step is recalculating your real returns, and this is where most people's financial awakening really begins. Don't just look at what your account returned last year and feel good about a positive number. Subtract the total fees you identified in step 1. Then subtract inflation using actual CPI data, or even better, the specific inflation rates for categories you'll rely on in retirement, like healthcare, which has been running at about 5 to 6% annually for years. That final number is your real return, the number that actually determines whether you're getting richer or poorer in terms of what your money can buy. If that number is 0 or negative, you're not investing. You're slowly liquidating your future purchasing power while maintaining the illusion of savings. You're running on a treadmill that's actually moving backward. The third step is the hardest for women who've been conditioned our entire lives to trust authority figures and defer to experts on things that feel complicated. You need to question the risk allocation you've been given. I'm not saying everyone over 45 should be 100% in stocks. That's not the point, and that would be irresponsible advice. But the point is that the blanket advice to become more conservative as you age is based on assumptions about life expectancy, investment returns, and inflation that may not apply to your specific situation at all. A woman at 45 with good health, reasonable expenses, and a long time horizon might be better served by staying more aggressive than conventional wisdom suggests. The risk of running out of money because your conservative portfolio didn't keep pace with inflation is just as real as the risk of short-term market losses. Actually, given current conditions, it might be more real. But no one's measuring that risk for you or warning you about it because it doesn't create liability for them the way a market downturn does. The fourth step is understanding that low-cost index investing isn't just for young tech bros with high risk tolerance and decades to recover from mistakes. It's actually the mathematically optimal approach for most long-term investors, regardless of age or gender. When Vanguard founder John Bogle developed index investing, he wasn't just creating a product. He was exposing the fundamental lie that active management adds value worth paying for. Decades of data have proven him right over and over again. Over 15-year periods, the vast majority of actively managed funds underperform their benchmark indexes. You're paying higher fees to get worse results. And for women over 45 who need every dollar working as hard as possible to close the savings gap we're already facing, those higher fees are wealth destruction disguised as professional management. Now, I want to address something that I know some of y'all are thinking right now, because I've had this conversation enough times to know exactly where the objections come from. You might be thinking that this all sounds overwhelming, that you don't have time to become a financial expert on top of everything else, that you've been trusting professionals precisely because you have a job, maybe kids still at home or aging parents to care for, a life that's already demanding enough without adding fee audits and inflation calculations to your endless to-do list. I hear you. I really do. The system is designed to make this overwhelming because overwhelmed people don't ask questions. Overwhelmed people trust the experts. Overwhelmed people pay the fees. But here's what I need you to understand. The time you spend on this now, even a few hours of focused attention over a weekend, could be worth tens of thousands or even hundreds of thousands of dollars over your remaining working years and retirement. That's a better hourly rate than any job you've ever had or ever will have. And you don't have to do everything at once. Start with one account. Your largest one, probably your 401k or IRA. Request a complete breakdown of all fees from your plan administrator or brokerage. Compare that expense ratio to the lowest cost index fund alternative that tracks a similar benchmark. Run the numbers on what that fee difference cost you over 10, 15, 20 years. Let that number motivate you to keep going and tackle the next account. Because once you see what's actually been happening to your money, you can't unsee it. And that awareness is the first step toward reclaiming your financial future from a system that's been quietly extracting wealth from you while telling you everything's fine. Let me leave you with this, because I think it's the most important thing I can say about the silent wealth killer and why it matters so much for women in midlife. We have been trained our entire lives to be grateful for whatever financial security we manage to achieve, to not ask too many questions, to trust the experts, to assume that if we just follow the rules and stay in our lane, everything will work out. But the rules were written by people who benefit from our compliance and our silence. The experts often have conflicts of interest they're not required to disclose in any meaningful way. And staying in our lane has meant staying in high-fee investments that erode our wealth while making other people rich off our trust. You deserve better than that. You deserve to know exactly where every dollar of your retirement savings is going. You deserve investment options that actually work for your timeline and your goals, not just options that protect financial advisors from liability while draining your accounts. You deserve to understand the real math of your financial future, including the uncomfortable parts that make the industry squirm. And you deserve to make informed decisions about your own money without being condescended to, dismissed, or told you're being too aggressive in your expectations. The silent wealth killer thrives on silence, on women who don't ask questions because they've been made to feel like they shouldn't, on women who accept explanations they don't fully understand because pushing back feels uncomfortable or rude, on the assumption that financial complexity means you need to trust someone else to handle things for you, even when that someone has every incentive to keep you in the dark. But the math isn't actually that complicated. Once you know what to look for and once you give yourself permission to look, fees compound against you, just like returns compound for you. Inflation erodes your purchasing power regardless of what your nominal balance shows. And the combination of these two forces, layered on top of the existing wealth gap that women already face, creates a retirement crisis hiding in plain sight on millions of quarterly statements. You have the power to stop it. Not by working harder or earning more or finding some magical investment that beats the market, just by paying attention, by demanding transparency, by refusing to accept that normal fees and conservative allocations are the best you can do, by understanding that your future self is counting on the decisions you make right now, and she deserves someone who fights for her with everything they've got. I'm not here to make you feel good about a situation that should make you genuinely angry. I'm here to make you rich, or at least to stop the invisible forces that are trying to make sure you never get there. The silent wealth killer has had enough time operating in the shadows. It's time to drag it into the light and deal with it once and for all on your terms. Your financial future is worth that fight. It's worth the discomfort of asking hard questions. And trust me, once you start fighting back, you'll wonder why you ever accepted anything less,